You know what time it is, everyone. I don't even need to explain it. It's Quickfire Finance, where I talk as little as possible so you can learn as much as possible without falling to sleep. So let's kick into it. Quickfire Finance installment. I have no idea because we've done so many. So let's kick it off. First question. When our eldest son was born in 1988, we were living in the UK and started a £30 per month investment into a unit trust. It was a moderate risk UK smaller companies fund. It has been a good but not top flight performer. We maintained contributions until early 2015, so invested under $10,000. The current value despite COVID is $60,700. I don't have the Excel skills to work out the average annual rate of return, but it is certainly single figures. Income was reinvested. UK unit trusts have lower charges than most NZ funds, but recent downward pressure by some Kiwisaver providers is improving things for the investor here. So before I kick into it, the word unit trust, a lot of people may get confused by that. The idea what a unit trust is, you pull your money together and you can buy a small percentage of a share in a sense. So instead of you having to get all this money to buy one share, you can buy units of it. And that's a lot of the most effective ways that people use investing right now. In terms of the fee structure around Kiwisaver, so there is a lot of monitoring that the government's doing to bring fees down, and the more years that flow by, the more that appears to be an objective, and that's what the public want. So I can see fund managers' fees just going down and down. And there was also a recent report by the FMA that found that it was comparing active versus passive management, and how Kiwisaver providers would justify that. The higher fees was the level of actively involved investment strategies in that, and the report found that they weren't necessarily as active as they were being portrayed. So something to be mindful of that. The other thing in terms of using smaller cap stocks, that's basically a smaller company, which makes sense. If you buy a house for $200,000, it's a lot easier for that to grow than it is for a house to go from $1 million to double to $2 million. So the idea with smaller cap stocks is if you have that overweighted in the portfolio side of things, so I won't go too densely into this, but we don't talk about investment on this level too much. So smaller cap stocks, if you're overweighted on that, they have a tendency to outperform. The problem though, there's a big long study they did, Dimensional Funds, it's a fund manager that the talks I go to sometimes, and they were saying that you also have to hedge it to profitability as well, because the smaller companies, for example, let's say they open a mine, initially that starts as a smaller company, but it has a lot of capital investment, and it could just completely flake. So if you hedge for smaller and profitability, you got a better chance. But we know that's not something you want to do as an individual investor. That's something a portfolio manager would do, because it's quite hard for you to have the finger on the pulse to be able to adapt and do those sort of things as quickly as possible. So in terms of that investment strategy, the challenge you're facing is, let's say it's hedging is the word they use. So hedging is to protect you against currency risk. So let's say you have £60,000 and then suddenly, like now, the New Zealand dollar is quite strong and you made a single figure return in the UK, but then the currency doesn't work out, so you actually lose money. So that's one of the challenges you face in having an international fund that's not hedged in New Zealand dollars. So at some point, they're going to have to take that out. I'm not sure the tax implications for them as well. That's another thing to be mindful of. So in terms of Kiwisaver, it's still a very effective very cost-effective vehicle. Also, we don't have a capital gains tax, so it's very tax efficient. And the fees are coming down, and it's diversified. So the biggest challenge with having a small company fund is it's basically shares, and it's going to go up and down like a yo-yo because they're small. They can grow very quick, but they can go downward very quick because they don't have the ability to soak up that risk. They're barely getting by a lot of the time. They're just living paycheck to paycheck. So what happens when suddenly that market tanks and you didn't expect that your house was going to cave in, or you didn't expect that you're going to have leaky homes, so you need that money now, you're going to crystallize a negative a negative loss, even though you don't want to, even though the investment philosophy might be good, you're going to have to take it out. So that's why we always advocate for diversifying across the 4 asset classes: cash, bonds, properties, and shares, because they perform at different times better than the other aspects. So shares may do well when bonds don't do well, and you just take out the money when you need it, and you're not necessarily crystallizing the loss. It has that flexibility. It has liquidity, because you could have the best car in all of the land. If no one buys it, what's it worth? So, yeah, always an advocate for diversified. Thought we'd go a bit more in depth in terms of the investment side, because we don't really talk about that. But yeah, hope that was valuable. And once again, thanks to nzaudioeditors.com. And for all those future people that are going to send me a question, at ryan@oneplan.co.nz. Thanks.